Hello, we are Team Iris del Campo and we are going to present chapter 5 and 6. To start, we have our break-even point, considering our fixed costs per month, sales price per unit, and variable cost per unit. Our break-even point is 321 jellies per month. We subtracted the sales price minus the variable cost, and finally we divided by the fixed cost. Our company will export 3,289 jellies per month, so our surplus is about 2,968 jellies per month. To calculate our costing, we have several assumptions like variable cost, fixed cost, operating profit, several costs, exchange rates, and finally our Mexican peso dollar forecast. Taking into account all these assumptions, we have calculated our costing in Mexican pesos, giving us a price per jar of 209.77 pesos. And finally, we in the same way as the costing in Mexican pesos, we calculated our costing but with our USD forecast, and it give us a price of $22.08, giving us a cost, insurance, and freight price of $9.5 per jelly.
To be able to get the sales forecast, we found the projections of Iris del Campo net sales from 2016 to 2024, and the growth of Finland, which is the country we're going to export our jelly to. Based on the GDP per year on the same years, with this data, we calculated the percentage of growth per year, obtaining a 2% on average, and through this, we calculated projections for the next 3 years, to get the amounts and percentages of the following years. We used the CIF initial price for 2022 that we previously calculated, and it gave us these results. In the first year, we're expecting a 4% growth based on the GDP growth of Finland of 1.4%, and then an increase in our sales of 6%. What draws our attention is the fact that in the second year, we expect a 10% decrease in our sales, but a 1.2% increase in the country. So overall, a 4% decrease is expected that year. For the following 3 years, we expect a continuous 2% growth in company's sales and a 1.3% growth in Finland's GDP. Having as a result that in 2023, we're going to sell around $394,000. In 2024, because of the decrease I talked earlier, we will sell around $377,000. And for the next 3 years, as I said before, we expect a 2% growth each year. So in 2025, we will expect selling $383,000. In 2026, we will sell $389,000. And for 2027, we expect to sell around $395,000.
Considering our costing forecast in US dollars, we multiplied every single cost we incur for 6, each for a month. The costs we considered are the fixed costs, variable costs, and each of the consequent costs that are included in the Incoterms. These are ex-works, free alongside ship, and free on board, and finally cost, insurance, and freight, which is the Incoterm we're going to be working with. We considered all these numbers so that we could get a more specific number of the investment we needed for us to be capable of operating freely and without worries in these 6 months, or well, at least for a period of 6 months. All of these things considered, the investment we need is 782,402 Mexican pesos. And also thanks to the research that we made about the interest rates that are offered by the most popular banks here in Mexico, we could figure out which source of funding would be more convenient to us. We made the research in which we considered Banorte, Banamex, HSBC, and Santander, amongst other banks. These were the most prominent because they came with the lowest cost of funding. So we could figure out which source of funding would be more convenient to us and fit more accordingly to the needs of the operation we were going to make. After this research, we arrived at the conclusion that Citibanamex was the one that offered the lowest interest rate and the one we finally decided to work with and asked for the funding. The interest rate that Citibanamex was offering was 14.25%. Therefore, we obviously chose to finance with them, and we asked for a funding of $37,257.
Hello, I will now be explaining to you our income statement. So, for our income statement, we made a forecast of the next 5 years, starting in 2022 and ending in 2027. In the first year, 2022, we had net profit of $43,902. In the next year, we went up to $44,937. This was an increase of 2.44%. However, quite unfortunately, our forecast showed that for the following year, we would be going down to $42,300. This meant a decrease of 5.44%. Following the next year, we would be having small but marginal increases. So we would be going up to 42,362, 372, and 382 approximately. These small increases may not be much, but this doesn't mean that we would be having losses. It just means that we would be gaining less. So we would, at the end of the day, be still having profit.
Now, I'm going to talk about the cash flows of the company. This is estimated from the sales of the company. We estimated 5 years, depending on the demand units, the prices, and the income. Based on our sales forecast and our cost, we have an initial contribution of 7,310.75 for the net working capital. So, then this is planned to do the contributions of each year, having a balance of 8% of our sales. Afterwards, we need to check the income statement, that is our sales, cost of sales, gross profit, operation profit, profit before expenses, and the net profit. We also have the operation cash flows, the net working capital, and the assets cash flows. We also are going to talk about the net present value. So finally, we calculated our net present value with the initial contribution plus the cash flow that presents the value, giving us the result of $136,380.15. We also have a tier of 352.4938%, and our return of investment taking an 6.5% rate of the project and an inflation of 7.36 of Mexico. Our assets cash flow will return us an investment of 13.86%. Having given of all these numbers, we think it's a very important product to export, and also we have a very good discount rate, basing our numbers on our net present value of each of the 5 years we have estimated.